Now, on top of addressing all my Alibaba bag holders, I'll need to spend some time to start addressing my Facebook bag holders too, in case you guys feel too left out. So just to get things out of the way, I do have a really small position in Facebook at the time of this recording. So I've made actually a few videos regarding Facebook prior to this, so you can check them out. Link down below. So what's the point of this video then? So I think from time to time, we as human beings do experience a certain degree of buyer's remorse. Was I wrong with my initial thesis? Did I misinterpret anything from the business? What makes me think that I'm smarter than the market? And what makes me think that this is an opportunity of a lifetime? Hence, I took the liberty to revisit the core arguments for buying into this business and just wanted to provide you a quick update based on its Q1 results, coupled with some new developments around the company in case you haven't been following. Now, on your part, you should take the like button's liberty away and banishing it by smashing on it now. Oh, and one more thing. Not sponsored by the way, but I know many of you out there probably have not maxed out all the available sign-up rewards. Currently, stockbrokers like Tiger, Moomoo, and even Weibo have extremely aggressive sign-up campaigns that gives you essentially risk-free return. Where can you get something like that? Moomoo and Tiger Brokers is giving out cash coupons and even free shares, and if you're lucky, you can get a free Tesla stock. While Weibo on the other hand is giving out $100 worth of Apple shares, and you shouldn't allow all these 100% ROI deals get away. I'll leave the link to all these brokerages in the description box down below. Clearly, there's nothing to hide. Facebook is by far one of the worst performing FANG stocks alongside Netflix. So let's not go down the rabbit hole of arguing who did worse. It's probably an unproductive discussion. So taking Netflix out of the picture, every other FANG stocks out there minimally is trading at 20 times earning, while our dear friend here went down to 13. Yes, I know, PE is an extremely crude metric, but we have to start from somewhere, right? So market have been brutal, to say the least, and I think we shouldn't refrain from thinking that we are always smarter than the majority consensus. So let's take a look at their recent quarterly report. So in Q1 of 2022, they actually reported a modest 7% growth. Nothing much to comment there since they have already guided for a slow year in the previous earnings back in 2021. However, the cost component essentially went through the roof. It ballooned to more than 30%. Cost of revenue was up 17%, marketing and sales was up 16%, general and admin was up 45%, and R&D was up 48%. Especially in today's market, if top-line growth for your core business remains strong, maybe in the north of 20%, you can continue burning cash all you want in all your other projects. Investors probably couldn't care less. However, this is a big however. It is essentially a double whammy to Facebook, where top line is slowing down and cost just keeps ballooning for God knows what metaverse even mean. Currently, there is an extremely heated debate on whether there is an effective cost control in the upcoming quarters, given the current backdrop and the climate of the stock market and business environment by and large. So coincidentally, there are positive news coming out of Facebook. I think it's a little premature to conclude. So at the end of the day, numbers don't lie, unless there are fraudulent manipulation of course. So at least for now, it looks really bad for Facebook, not going to sugarcoat it. So we can clearly observe that this metaverse thing is going to be a drag on Facebook's result in the foreseeable future. It has just been abysmal. So revenue from Reality Labs increased by 30%, but losses gapped up by 60%, just to bring in 2.4% of Facebook's current total revenue. Mathematically speaking, none of this makes sense. Yes, you can try to educate me on what the metaverse is and how is it going to be the next frontier of innovation, but in today's context specifically, investors don't care, and you, including me, have to understand and accept this reality. This reality is not that Reality's Lab reality. Get it? Okay, lame jokes aside, Facebook currently has one of the strongest balance sheets on earth. Not going to deny that. It has 45 billion in liquid asset, and if you were to add accounts receivable and prepaid expenses, the current asset sits at a whopping 59 billion. 45 billion in cash and marketable securities. Do you know what concept is that? Facebook currently trades at $475 billion valuation. It means that you are getting around $15 worth of cash value when you buy the stock today. So let me just keep this out of the way. I think nobody is betting that Facebook is going to go bankrupt anytime soon. Investors are, however, betting that competition is probably going to be extremely stiff And just take statistics from anywhere, it's not looking good for Facebook. So this metaverse push seems like a necessary evil for its business. Without it, people are essentially predicting that Facebook's core business will slowly dwindle away. However, this business is still a crazy cash generating machine. They just printed around $37 billion of free cash flow just last year. People can claim that it's a dying business all day, all night. But if they continue printing $8.5 billion of free cash flow per quarter, it doesn't look dead, at least to me. However, the market is always forward-looking, and people are essentially just not confident that Facebook can come out stronger from this. So I think specifically for instances like this, it helps when the company has a strong track record of both execution and also financial metrics that people can fall back on in times of difficulties. However, I preface this with great caution. Nokia died, Kodak died, and the current automobile industry is also under huge amount of pressures. So I won't say this time is different, but I do think it's a little premature to conclude that Facebook is dead. Now, if you're to just pull out any graph from the internet, from downloads to organic growth to user retention to active users to time spent, and the list goes on, the numbers just look bad. It's a fact. So let's take a look at a few. So this graph shows Americans aged 12 and above on their social media platform usage. Yes, I know. Even though the US only probably constitutes 4 to 5% of the world population, this group of audience is worth the most amount of money to advertisers, as they control the bulk of the revenue generation for Facebook. You can see that US and Canada actually makes up around 8.9% of the monthly active users, but 44.5% of the advertising revenue. I'm not going to pass a judgment statement here on whether this is fair or not, or whether this will change in the distant future, but we need to work around this fact. So if we go back to the graph, according to the trajectory of the last 3 years, TikTok is going to overtake Instagram or Facebook sooner or later. Fortunately or unfortunately, the main audience for TikTok as a platform still largely concentrates in the younger demographic. And we know that monetization ability as a platform is incredibly tedious for TikTok. It's not only a TikTok problem, by the way. Facebook is also having their fair share of issues in trying to effectively monetize Instagram Reels, which is their quote-unquote answer to TikTok. From a creator perspective, people go onto TikTok to build an audience and following. To make it a full-time job, the inherent mechanism is also not matured enough. They have to branch out elsewhere. Also, spending power do matter. Although people like to laugh at Facebook being a quote-unquote boomers platform, it's exactly those boomers that can go out and drop a few grand on a month on discretionary spending. However, the longevity of the platform is then called into question if they are unable to continuously attract the younger folks, and I concede to that factor. Recently, Zuckerberg also unveiled a WhatsApp Cloud API, essentially allowing businesses to customize the customer experience in WhatsApp. So it probably helped in boosting usage of WhatsApp Business, and just based on the most recent data released in May, WhatsApp Business increased by 10% in downloads. The funny thing is, although we are constantly fed the impression that hey, Facebook is a dying app, Meta Platform's family of app is losing relevance, numbers don't lie. And Instagram is currently tied to TikTok, despite being below it for multiple months. Dead platform? Time will tell. So recently, I had an interesting discussion with someone in the community on Facebook's ability to build a super app ecosystem, very much like WeChat in China. So I think the potential is still there, but Facebook has missed the opportune time to do so, which was the last decade. So I'm not hopeful and I'm not betting for that to happen either way. Besides, I think there are fundamental differences in the makeup and the type of users between WhatsApp versus WeChat. So it's probably an insurmountable task for Facebook to reach the status of a quote-unquote super app. Lastly, I just wanted to pivot over Facebook's ability to pivot. Pivotception. Get it? Anyhow, I think we know that in late last year, when the entire economy is essentially booming, every company out there is literally just printing money and hiring. So Facebook also announced that they are hiring 10,000 people in the EU to work on the metaverse. So it actually took headlines in several media reports. Subsequently, Zuckerberg said that they will slow down the pace of some of their investments due to the current business growth levels, and then Facebook froze hiring in May for the rest of 2022. Ultimately, Facebook is still a business at its core, and the management don't seem to have quote-unquote lost their way. Like I alluded to previously, Facebook has been rather effective in taking care of shareholders in the last decade. And I don't necessarily think that Mark is someone that just blindly devotes resources for an ideal with such a high risk without considering the financial aspect of the business. So you should come to your own conclusion at the end of the day. Both bulls and bears have valid arguments, and we can only know who is right or wrong post-mortem. Last part of this video, I'm not going to spend too much time explaining the assumptions of my model. I think it's pretty self-explanatory. If you have any questions, leave in the comments. So I projected cash from operations to grow based on consensus amongst analyst estimates. I bumped up the capex to 30 billion in 2022 as guided by the management to be between 29 to 34 billion. Now, given the current price of Facebook sitting at around $175, we can roughly gauge what the market is taking into account. Assuming that the growth rates of the cash generated and capex is rather accurate, so we are essentially tagging a 15 times price to free cash flow multiple and using a discount rate of 15%. So I'll give you 4 potential factors that will affect the valuation. 1. Due to the macro environment, they decide to slow down their capital expenditure, coming in lower than the lower bound of their guidance of 29 billion, and this inevitably jacks up the free cash flow. Number 2. Facebook somehow manages to find their footing and reclaim their throne again. They don't have to win TikTok, they just have to be on par with TikTok. Projections from 2023 onwards reverts back to the north of 20%, and this 10% growth from here on will look like a joke. Number 3. They experience a multiple expansion again, because we are currently at the lower end of its entire history. However, this is hugely contingent on investors liking Facebook as a company. Number 4, a discount rate of 15% is basically a vote of quote-unquote no confidence on the company's execution, and as long as there is a change of sentiment on the strength of the business and their cash flow, I don't think this discount rate of 15% is actually justifiable. All in all, I think Facebook deserves to be punished for posting such results with such real-world performance compared to its competitors. As an investment, I like the risk-reward. So if you believe that Facebook can come back even stronger, you are getting a deal of your lifetime. The stock is down for a reason, and investors don't think they can do it. I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!